First rates, a lot of green, solid market breadth, and a good start at least for the Nifty. Let's look at some newsmakers now. Indian Energy Exchange, 3% higher. You've got Reliance Power, which is chugging along very smartly. And then you've got Infra, which is also moving on very smartly. So markets are off to a good start. I think it is empirically evident in the way how things are moving on the breadth front. So the breadth, I think, is the talking point, and I think the breadth is the talking point for a long period of time, which is what I think is important here. No large newsmakers. You want to look at Honasa, you want to look at Titan, you want to look at the Chola group of Murugappa group of companies, because they were the real big boys in terms of the market action, in terms of semi-large cap. The breadth is strong, but I want to look at Jubilant also, because CLS has come out with the sell report on Jubilant. Let's look at that one. But barring that, I guess there are no fireworks, but I think the trend in a sense by and large is on expected lines.
Yeah, no fireworks really. It's only real estate sector in terms of the sectoral trends which is standing out. That's because Mahindra Life is actually starting higher. Metals are also doing well. So Welspun Corp continues the up move, and NMDC too is holding up in the green. But separately, not too much to talk about in terms of individual movers. You of course have the stock specific reactions coming in. Bajaj Auto is higher by around 1%. Power Grid is also higher, and then you are seeing a bit of a move on Infosys continuing from yesterday. So that's one of your top contributors at the index level right now. Adani Ports too has managed to open with a bit of a green tick. Sterling Wilson Solar is higher by 5%. MapMy India is holding up. CDSL is higher in trade, and then EID Parry from the entire Murugappa group is also higher. Home First, as we talked about, is down about 5%. Tube Investments, I think, is coming under pressure. Let's pull up the stock of Tube Investments and see if those rates are making sense or not, because it's suggesting a downtick of around 5%. And then KEI and eClerx are a couple of other big buzzers, but overall, a very, very quiet and tempered opening amount.
Absolutely. So it's yet again a range-bound day of trade. And by way of individual sectors, yesterday, of course, you had the banks that were on the back foot. Today, banks are absolutely quiet, and pretty much across the board, sectors are quiet. But real estate, PSU banks, that's where you're seeing a little bit of traction. All sectors, by the way, in the green, barring pharma. Let's find out, Kunal, what you're making of the market open this morning. What's the view on the Nifty Bank Index at 43,500 in your top trade?
So at least it's a slight positive start for the banking index, not an outperformance as such with respect to the benchmark index. But again, as I said, that hopefully we would probably expect a follow-through up move for both the indices on a gradual basis. Now, in terms of opening trade, Hero Moto Corp is something which looks attractive. We've seen that from the short-term spaces, the auto stocks have done reasonably well. So that's a stock which I would pick.
What about you, Naresh? What's the first trade?
So that would be a buy on Sun Pharma, which has hit a new 8-year high. So expecting it to slowly and steadily go towards the 1280 to 1300 mark.
Mark Matthew joins us now, and let's connect with him to understand the market texture, what he makes of the global environment, and in the short term, when I say next 3 to 6 months, Mark feels that seasonality could be at play. Mark, fantastic to have you back. Is that a Santa tie by any chance? I can see red, but is there Santa Claus on it?
It's just a regular tie.
So the Santa has not come. Do you think the Santa is going to come this year before year ends? Santa, the bull market Santa?
Santa rally, yes. I think we're starting to see it now. Technically, isn't that the period between 25th of December and the end of the year?
What makes you confident, or what gives you a underlying thought that the Santa this year will not disappoint?
Well, as I said, specifically, the Santa rally is from the 25th of December to the end of the year. So that's only 5 or 6 days. And who knows if that'll happen or not. But I do think that the market should go up. And there are several reasons. The first is that I think the economy in the US will slow next year, but not enough to be in a recession. We're looking for around 1% GDP growth next year, which is extremely low, obviously, but it's not zero. And you still have a lot of growth coming from these big technology stocks and earnings. And I think that will continue because of the investments they're making in their cloud computing businesses with generative AI, and that will be incredibly accretive for their revenues, but for the entire S&P over the next few years. So those are the two main things, I think, is that we're going to have the economy decelerate, but not enough to be in a recession, but enough that the Federal Reserve will be more relaxed about inflation and interest rates. And then number two, still very strong structural growth in technology through the generative AI story.
You talked about S&P, you're talking about technology, i.e. NASDAQ as well, but for a bit of a long term, let's say, next 3 to 5 years, if I can call it that, would you prefer Indian markets over the US markets, or continue to be overweight US versus India?
My best guess is they'll do about the same, but I do feel that the United States is the best market to invest in equities and, by the way, in bonds. And there are many, many reasons for that have nothing to do with GDP growth, of course, because in the United States, GDP growth, being a mature economy, is relatively low. But we should have figured out by now, looking at China, that there isn't really a correlation between GDP growth and stock market performance. And in America, I think what it comes down to is simply that the technology sector is the largest sector in their stock market, and it has returns on equity in the mid-20s, sometimes even in the 30s. It's an incredibly profitable sector. And they just have the ability to invent and create great new things. And so I think with generative AI, we're on the cusp of that all over again. I was just thinking this morning how back in the 90s, I didn't know anybody who was working in the technology sector, apart from a cousin who worked at IBM. And now I have many, many friends in the technology sector. And the reason is because those magnificent seven, they didn't even exist back in the 90s. And I think that with generative AI, we're on the cusp of a whole bunch of new technology companies. They probably don't even exist right now, but they will over the next 10, 20 years. They'll rise and become big. And that's something that you really see only in the United States.
Mark, hi there. Morning. What's the outlook when it comes to the earnings growth potential as well for India? What is it that you're forecasting versus the rest of the world?
Above average, so in the high teens, potentially low 20s. And you're right that it's good. So I was just talking about the United States, but absolutely the appeal of India is the earnings growth. And I think that's being driven by, in part the strong economy, but also the resilience of the banking sector after years and years of taking that painful medicine of writing down the non-performing assets, is now in a place to lend. We've got a capex cycle. I think that's undeniable, and it'll continue. And the banks are the biggest sector in the Nifty.
Mark, now the biggest moving part in last 12-18 months has been how long interest rates will move higher and when will they hit a roof. Assuming that interest rates is not a moving variable for 2024, but elections are or will be, both for India and for United States, two largest democracies would be voting. What kind of volatility do you think it will create?
Well, I have to politely disagree with the way you've asked the question, because I don't think that politics are a defining factor of the market. They never really have been. You might remember in the lead up to the 2016 election, people were terrified of Donald Trump. Well, we ended up having great stock market performance during most of his administration. It wasn't really until the very tail end when the pandemic came along, and that wasn't his fault. So I really don't think it matters that much who wins the US presidential election. And in India, I don't think there's going to be actually much chance of the opposition coming in. I prefer to focus on the earnings growth in both places, and I think in both places it'll be good. So I mentioned India will be high teens, but we're probably looking at low teens. So I'll just put out a low number of 11% earnings growth in the United States next year and the year after. It's hard to see the market go down if you've got double-digit earnings growth.
Sure, so banking is one space that you're looking at positively, but how else are you playing the India theme? Is consumption something which is on the anvil? Real estate has been doing well. Have you been dabbling into any of those names?
Yes, very much. So real estate we would play through building materials, which also benefit from the infrastructure spend. The consumer is definitely a good story in India, which would benefit from the rising GDP per capita. Ernst & Young think that GDP per capita, which is about $2,600 today, will be $3,700 by the end of this decade. We would like to play that through the automotive sector. And then we like pharma because it looks like the price pressure in US generics is coming to an end. So there's several other things, but to go back to what I said originally, the banks, I think, are, as simple as it sounds, a good way to play the fact that you have a capex cycle after many years when the corporate sector really was starved of capital because it couldn't get loans, and now it can. So to me, that just kind of, I hate to use the term, but it just kind of looks like a no-brainer.
There is an important point which, Mark, you've said that this is part of your core philosophy. It is fun to listen to the market. Don't let that influence your investment. Buy good quality companies when there is fair price and buy more if they fall more. So what is the market chatter which you're ignoring, and what is a good quality company which is there on your radar?
Well, first and foremost, the politics. I think you can ignore it. And I'll give you a classic example, as gruesome as it is and unfortunate as it is, what's happening in Israel, which is not impacting the market. Look at the oil price. It's back in the low 70s now. And so I just think that what you want to invest in is good quality companies. They exist everywhere in the world, by the way, but they seem to be more prevalent in the United States than anywhere else in the world. And I think the reason for that is because the middle class in the US is highly invested in the equity market, and it insists on good corporate governance and shareholder returns. And if you don't get that, they'll change the board, they'll change the management. Also, in the United States, the way the S&P 500 index is created, obviously it's a weighted index, and so it naturally pushes the best companies right to the top. The worst companies get pushed right out of it, and there's a whole bunch of companies in the middle that get acquired. So actually the average lifetime spent on the S&P of a company is only 12 years now. That's down from 60 years back in 1950. And the reason is because the M&A is so strong there. And so I could name a whole bunch of other reasons, but that's what all you need to do is buy the good quality companies and hold them. And now the thing is that companies do change over time. I mentioned IBM earlier when I said my cousin worked there. IBM was the great stock back around 1965, and today it's obviously not nearly what it was. So you do have to be nimble, but in a way the S&P 500 index does that for you because it's constantly making the changes of the companies.
Mark, would also be interested to know, I'm sure that you're a voracious reader and there have been very interesting books that you've come across, but would there be anything in particular that you would like to, advise our viewers to or recommend, maybe something you've read recently that has caught your attention or made you think a little bit more?
Well, just because I mentioned the 1960s and IBM, there's a book, I didn't read it recently, but a book I like called The Go-Go Years by a fellow named John Brooks. And he was a financial journalist, a little bit like the Michael Lewis of the 1960s. And the Go-Go Years, just to preface it, we all know the meme stocks, a couple of years ago. And those all tanked, didn't they? They went down about 80%. We all remember the dot-com collapse. And stocks also went down about 80%, the NASDAQ. So the go-go years were a very similar technology-driven bull market in the late 1960s. And the few dozen stocks, IBM was one of them actually, that everybody was enraptured with back then. They went down over 80% in the early 1970s. And so I just thought it was interesting to to read that book, apart from the fact that John Brooks is a fabulous writer, so it's highly amusing to read, but you just realize that this trend of technology-driven bull markets happens over and over again in the United States. I suppose I'm contradicting what I said earlier about the great thing in the S&P is technology, but I think that it is great because the S&P is an index that pushes the best companies to the top and then pushes the worst companies right out of the index, so you don't get stuck with a bunch of deadwood.
Good chatting with you as always. Appreciate you making time and speaking with us. But on to an important news break that we have for you here on ET Now, and this one is coming in for the IDBI Bank. It seems like there's a high-level meeting which is going to be scheduled for later today, and even the finance minister is likely to attend to decide the next course of action. Sumit is standing by to bring us the latest detail on this one. Sumit?
Well, absolutely. The high-level interministerial meeting will happen today. It will be attended by the Department of Financial Services Secretary and DFIN Secretary. It's definitely going to have presence of Finance Minister as well. We all know that government is going to reissue bid for asset value waiver for IDBI Bank sale. It's not going to happen this financial year, but it is not completely on hold as well. The government and LIC, they are planning to divest 30.48% and 30.24% of their stake. So the process that's going to carry on, and today's meeting can throw more light on, or more emphasis on the planning part of the overall IDBI Bank disinvestment. DPIM, which is Department of Investment and Public Asset Management, it yesterday scrapped bid for asset valuer for strategic divestment of IDBI Bank. And if this move can, we know that delay disinvestment plans, but it's clearly not of the mark of the books. So the discussion will be around that thing only, and this high-level meeting will have attendance of Finance Minister, DFS Secretary, and DPIM Secretary.
Thanks so much then for taking time out and giving us those latest details with respect to IDBI Bank and the divestment. But let's move right on. Let's decode then the move that we've seen within the broader markets. From those lows, the ferocious up move within the mid and the small caps. Does that mean that the kind of pullback that we're seeing is spelling out a larger correction, or is it just a bump along the road? Feroz Aziz, Deputy CEO Anand Rathi, joins in to analyze that and lots more. Thanks so much for taking time out, Feroz. Let's just begin by talking about the kind of move that we've seen within the broader markets of late. What do you believe that is? What do you believe that indicates?
Aman, it indicates a lot of stuff. We had gone long on small and mid caps, small caps largely on your channel as well on 3rd of January this year. So this indicates several things. One, which is a clear difference between 5 years back and now, especially in the small cap space, is FII's participation has gone up dramatically in the small cap space. Earlier, the FII would want to play the India story only with the top 50 or the top 100 stocks at best. Now he or she wants to play the India story from a broader theme perspective. And these small cap stocks are low on market cap generally. So there's lesser free float in terms of rupee value of free float. So PEs get elevated significantly because FIIs are a little price insensitive, or they are not price elastic, unlike the domestic guys. So they're buying India, not buying the specific stock alone. So that's why you see several re-ratings. And wherever you've seen PE re-ratings, you see the FII exposure change. So I analyzed the about 10 companies which have had the largest change in FII holding in the small cap index of Nifty Small Cap 250. You would see a substantive move in terms of price movement and the PE movement if FIIs increase the stake. So point one I'm making is it indicates that broader market interest from FII has gone up dramatically, mathematically so. Second, it says that India is a reasonably large number of stocks in the capital markets, largest in the world, in fact. So India can't be represented by the top 100. So the domestic guys have also had flows over the last few months. So there's several things, but I'll stop here for the next cue from you.
Office nahi aaya? Your office is like right opposite our office. I asked our guest team, they said Feroz bhai is busy in his office. Office to samne hi hai.
No, actually I was traveling. Otherwise, it would be an honor to be in your studio.
No, look forward to that. My question, Feroz bhai, is very simple. there is a lot of narrative which is that, okay, there is a bubble and a trouble in small cap stocks. Small cap stocks in a tortoise and a rabbit race are like rabbit right now, and they will not reach the finish line. But it is time now to bet on the tortoise, which is large cap stocks. Do you think a strategy which do you think anybody is watching the show, and if somebody wants to check asset allocation, is it time to book 15-20% profits from small and mid cap funds and perhaps migrate back to large cap stocks or large cap funds?
Nikunj, if first on a conceptual level, I have a little disagreement with the narrative built. See, small cap stocks are the top, are the bottom 250 stocks of NSE 500 as per SEBI's definition for a mutual fund investor. Putting 250 companies in one judgment itself is fundamentally incorrect. And you would be, I'm sure you would know, or you would be surprised to know, like I discovered, the smallest stock in the small cap index is a 3,200 crore market cap company, and the largest one is above 50,000. And it's still called Suzlon Energy is the largest index in largest weight in the Nifty small cap 250. Now, a 50,000 crore company is also a small cap company. A 3,200 crore company is also a small cap company. There are 51 unicorns in this country who are not a part of that small cap index because of the index formation methods. So putting paint, coloring them with the same paint or same brush is not right to my mind. So the name of the game is to be specific in small cap. Nifty, you can be more broad-based. You can judge 50 companies as a basket because they represent a larger free float, almost 65-70% of India's free float. So point one I'm making is don't do the mistake as a viewer, I would like to say, painting them all with the same brush. I'm not saying they're not undervalued or overvalued. If the largest stock is 106 PE and there's another stock with 9 PE in the same index, how can valuation be same for all of them? But now, if that's not the criteria, then what is? If you look at the Nifty small cap 250's value today, close to about 13,000, the earnings estimate tells me that the PE is still 19. And if you look at the froth in that index as a whole is negative. Even if you attach a 21 PE to it, 1,000 points of further rally is expected. But the name of the game is to get specific. And not be judgmental about the broader headline numbers.
थोड़ी trade security की बात करते हैं. Which are the top 3 small cap funds which you are recommending as a house? I mean, I know you charge fees for that, but maybe I'll urge you to say it on air for free.
Of course, I'll do that for free because I don't have any variable cost. I've already put in the request. I'm more than happy to get you of any assistance to anybody. HDFC small cap, Invesco small cap, and Birla small cap. All of them have a very different approach, is why these are the 3 small cap funds. Chirag Setalvad is a great fund manager. In spite of the size, he has the knack of smelling businesses. When you look at his portfolio, there were about 17 stocks less than 5,000 crores, and those were not stocks picked by all Janta. They were brought into the portfolio much before the market woke up. That's Chirag Setalvad. Tahir Badshah is managing the Invesco small cap fund, a smaller size small cap fund, which is getting inflows. So I think Tahir Badshah has shown his capability in the small cap even when he was in Motilal Oswal. So that's the second fund. Third one is Birla small cap. It was one of the underdogs when we picked it up. Of course, people would never want to buy it, but this year it turned around and it became one of the best in the 385 active funds. So I think these are the 3 funds which have a complementary nature in the small cap space. But we have a research team which on ground works to find out flows in the small cap space for the month before Amphi gets to know it at the end of the month. I think the estimate is by now, in the month of November, we have seen about 2,400 crores of inflow in the small cap funds. If you look at all the small cap funds in the space, and liquidity seems to be still chasing these categories. So I think a few months later, I would be a little more worried about valuations here.
Years forward, last 3 years, small caps have given returns which are better than large cap. 3 years, will the tide turn? Like they say, cyclicality is always at play. In this tortoise versus rabbit race, tortoise wins in the traditional story जो हमने पढ़ी है. मगर in a mutual fund, sometimes tortoise आगे होता है, sometimes rabbit आगे होता है.
वाह, निकुंज जी, जैसे आपने कहा ना, अगर हम देखें आंकड़ा 3 साल का स्मॉल कैप ने आउट परफॉर्म कर दिया. हमने जब स्मॉल कैप को अपने पोर्टफोलियो में 5% से 30% का निर्णय लिया था, तो हमने बहुत सारे एंट्री पॉइंट देखे। अगर एक एंट्री पॉइंट देखे ना, तो क्या होता है कि उसमें एक बायस सी आ जाती है, क्योंकि स्टार्टिंग पॉइंट पे निर्भर करता है। अगर मैं इसमें 5 साल डाल दूं, और 2018 आफ्टर द IL&FS crisis, you would see small caps got rogered, and you would see underperformance for 5-year period. Almost about 4.7% was the underperformance of Nifty small cap vis-a-vis Nifty on the day when we gave the recommendation. So if you look at the number of days in the small cap has traded, I think it was 2007 to 2008, and then see how many times has it underperformed Nifty. We are still in a 5-year pocket of underperformance with respect to Nifty. On a 3-year performance basis, of course, like you rightly pointed out, it has outperformed. I think there are several ideas inside small cap. So a great canvas for a fund manager, he can capitalize. So I'm not too worried about the 3-year outperformance, because if you pull it a couple of years behind, the outperformance disappears.
Let you go, Feroz. Leave us with the best portfolio allocation right now. What would be, your exposure to mid cap, small cap, gold, if at all, other asset classes?
Yes, so in the large cap, in our current 14 scheme model portfolio, the implied large cap exposure is about 50%. There is about 29% of small cap and 20% of mid cap. It is very, very contrary to how a person would believe. 50 is for large. Generally, mid caps have a larger allocation than small caps. We've turned it over its head. Small cap has a larger allocation than mid cap, because we're not very comfortable with the 150 companies. Earnings potential, which is called mid cap. Now, coming to from an asset allocation standpoint, I think India is going to an election year. Having large portions of debt is going to be very detrimental. India's allocation to debt is significant with respect to only about 12-13% of India's households have equity, and the rest of the 85-87% is debt and other instruments. So I would say that going into the election, if you stay out and stay in debt, it would not be a great thing. So I would say very little allocation for long-term monies in debt. Gold is definitely a great hedge and a good plan B. You can have sovereign gold bonds, because you get a fillip of almost about 4% per annum because of the tax advantage, and also the fact that you get an interest. So sovereign gold bond is gold plus plus. And if a person realizes that and converts all his gold, which is coins, bars, not jewelry, of course, the women would be very, very upset with that recommendation. So coins and bars could be converted to sovereign gold bonds. That's a more important efficiency item in the portfolio than buying new gold itself.
Good to have you on board. Thanks, Feroz, for joining in and giving us your take. Quick break. Be right back with the management of Mamaearth.
So glad you like the apartment. And this is our swimming pool.
पर इतने प्रेशर में कैसे जिएंगे?
Housing.com, जहाँ है मैक्सिमम प्रॉपर्टीज. Housing.com पर से परफेक्ट. डाउनलोड नाउ.
Welcome back. Ramanpreet Sohi is the Chief Financial Officer at Hanasa Consumer, here to talk about the robust performance. And thanks so much for taking time out. A 21% year-on-year growth this time around. And, the company has been talking about delivering this 30% growth rate going forward. Is that looking achievable? And what will be the drivers?
Hey, hi. Good morning to all. Thank you so much for having me. So I think, what we've also indicated is that you actually need to look at H1 results. I think we've delivered a 33% year-on-year growth and a like-for-like growth of almost 36%. Most of it is volume-led. So we're seeing good traction. We are focused on investing and building our brands. Our younger brands are doing really well. All of them have achieved new milestones during the quarter. Our largest brand, Mamaearth, continues to scale. We continue to build our brand on the offline side. Our distribution expansion increased by almost 47%. Year-on-year, we've reached almost 1.65 lakh retail outlets. So I think our focus on building brands and focus on expanding our distribution, strengthening our distribution is working well, and we continue to double down on all of these things.
Which are the categories where you think you would be able to in a sense, grow and maintain this kind of a growth rate? Because there is a traditional FMCG business which is now reaching a mature curve, but the categories which you represent essentially are very niche and have an online presence. So which are the categories where you're confident of exceptional and strong growth?
Yeah, sure. I think just to clarify, almost 40% of our business comes from offline now, and hence our brands and categories, especially Mamaearth, is largely the focus in terms of incremental growth is coming from offline for us. We are present in multiple categories, face cleansers, moisturizers, shampoos, oils, and also emerging categories like sunscreen. We're seeing good growth across categories. Of course, we are also focused on the market share game here. So I think we're seeing good gains across categories. But of course, some of the emerging categories would be serums and sunscreens for us. I think that's as categories. They're also something that we're seeing penetration gains coming in for these categories.
FMCG category, if I talk to some of the large established brands, whether it's local brands or global brands or MNC companies, they are saying the following: penetration has already happened, volume growth is low, and the base effect has kicked in. But if I hear the commentary, what you just stated, you pretty much are saying the opposite of that. Penetration has started, category growth is strong, and we are confident of a double-digit growth.
No, absolutely. I think one thing I want to call out there is that we are focused on masstige and mass premium categories. And I think as a business and as a house of brand, all our brands play in the mass premium, masstige categories. And this space is expected to grow at almost twice that of the mass segments in the country. I think given that and how the whole online, offline ecosystem is evolving, we are fairly uniquely positioned to capture this evolving opportunity in the beauty and personal care space.
One of the concerns that the street had at the time of IPO was the high advertisement spends, right? Talk to us about the trajectory of bringing it down and how the operating leverage will kick in, because this quarter as well, we have seen an improvement in margins. What could be the trajectory going forward in terms of margins?
Sure. So yeah, I think from a first half perspective, we've delivered 7% EBITDA margin for first half. We expect a similar kind of a margin profile for the rest of the year. That's our endeavor. So that and the expansion in margin that we're seeing in H1 is more structural. It's something that we think will be sustained. Most of it, as you rightly said, is led by leverage, and leverage kicking in two particular aspects of a P&L. One, of course, is the A&P. We saw almost 260 odd bips of A&P rationalization, and of course, we think that that's something that we had planned for, given how our brands are scaling, how Mamaearth as a brand continue to grow as we invest and grow that brand. Also, as the younger brands grow and mature, we are clearly seeing leverage in A&P, and also across other P&L levers. Payroll cost is the other aspect, and other overheads we're seeing leverage kick in. And hopefully, that's the focus. Focus is, of course, continuing to grow and deliver a market-beating growth, but at the same time, ensure that we grow efficiently as well.
Once your offline strategy does scale up, because you articulated that during the IPO as well, do you think the ROC, etc., will kind of take a dip? And how are you looking at the entire, offline strategy in terms of the pace of expansion?
Sure. As you see, we are a negative working capital business and a very capital efficient business in our journey so far. And in this journey, of course, our focus on offline is a 3 to 4 year old channel for us. We're doing really well there. Our execution has been pretty good. But at the same time, if you actually look at our capital efficiencies there, we've continued to maintain our working capital cycle. So I think our focus there will continue. The business, of course, is capital efficient, doesn't require that kind of a cash investments, in terms of how the channels are panning out for us. So we don't see that, too much of a deviation when it comes to capital efficiency of the business. Even today, 35% of the business is offline, and we are negative working capital cycle. So I think that's how we are positioning, and we're fairly confident that that's how we'll continue to deliver and build this business.
Fair enough. And what is going to be the next hero product? And can you also tell us a little bit more about how some of the hero products compete with the large, very well established FMCG players? So what's the strategy to deal with that?
See, I think in terms of our focus, innovation is a key strength. Almost 13% of sales for the period has come in from innovation. That continues to be our biggest growth driver. We continue to focus on innovation based on data science tools that we have in-house. That's one of the key strengths for our business. And of course, we want to stay ahead of the curve and continue to innovate. Of course, some of the innovations, we've launched recently have been focused on ingredient innovations like rosemary, multani mitti. We're also working on leveraging cultural nuances of the Indian consumer. I think that's a big strength for us, and we continue to focus and build all our brands on innovation-based pipelines for us.
So let's understand the mindset of an investor here. An average investor would say that why should I buy a Honasa stock? Because the return ratios are not best in the industry. Yes, the growth is one of the highest. That's the purist who looks at return on capital, return on equity, free cash flow generation. So how would you tell a new investor saying that your business indeed is different?
Sure. So I think a couple of things. Firstly, of course, on the growth aspect, I'll talk about. We are one of the fastest growing, consumer companies. Growing at almost 3 times faster than the market. Of course, our margin profile is evolving, and now, of course, with our focus on efficiency, we are also starting to deliver and execute on the margin aspect. Also, on the return ratios, as you mentioned, I think we are a fairly capital asset model. If you look at our balance sheet, if you exclude cash, and if I have to analyze our performance of first half, we're almost at 50% plus ROCs. If I have to exclude my surplus cash from the balance sheet, so I think it's a business. Which will, given the opportunity that exists, we'll focus on ensuring that we continue to deliver market-beating growths, ensure the margin profile continues to improve given leverage-driven efficiencies, and hopefully, investors will see us perform and deliver quarter on quarter.
We are in FY24. FY27, 3 years out, when the business would have reached a curve of operating leverage, margins would have kicked in. What is your aspirational number for return ratios, return on capital and return on equity? Where do you think you want to take the company to?
I think the focus is clearly on delivering growth and delivering growth which is backed by a profit growth which is faster than top line given where our margins are, and I think that will solve for itself. Our return ratios will continue to improve. Like I said, if I exclude cash today, we are already delivering 50% plus ROCs, and hence I think that those ratios will continue to improve. I don't think so I can call out the exact number 3 years from now, but clearly we see return ratios for this business, given it's an asset-light model, negative working capital cycle. We don't see that as something that will worry us. I think our focus, if we are able to deliver our growths and continue to grow the way we've grown in terms of growing efficiently as well, we should be very healthy return ratios.
So since you're focusing on growth, tell me, is this 35% growth rate what we should expect for the next 12 to 18 months as well? That's what you delivered in the first half?
See, I think, like I mentioned earlier, the focus is, the endeavor is to ensure that we continue to deliver growths in a similar range, 30% kind of range, given how we are focused and structured. That's the endeavor for the management.
On that note, we let you go. Thank you so much for making time and speaking with us. A quick check on the buzzers. Of course, Honasa is the big one, which is high by around 17-18%. The other one is Man Infra, which is high by 11%. Quest Corp, Prudent, CDSL. These are some of your high flyers, whereas Tube Investments and RateGain are taking it on the chin. They are down anywhere between 7 to 10%. Time to slip into a very short break. Don't go anywhere. When we come back, we discuss the outlook for the logistics sector with All Cargo's management.
All right, welcome back. Still tuned into First Trades. Yes, Honasa Consumer is up and away, double-digit gains, clearly cheering a strong set of earnings that the company has delivered. But what else is looking good? GE Power, Quest Corp, Indiabulls Real Estate, and even a Manappuram Finance. Those are some of the buzzers in today's trading session, but let's focus in on All Cargo Logistics, talk a little bit more about the volume growth as well as the growth roadmap with Ravi Jakhar, who is the Chief Strategy Officer at All Cargo Logistics. Ravi, thank you so much for taking time out and being with us. Now, as per the October updates, the volumes across all the segments have been impacted due to the Golden Week holidays in China last month. Is there any sense now of an improvement in demand? Are you seeing a pickup in volumes?
So there are two segments if you look at in our business. On the international supply chain side, the global trade has remained muted. And that's where we have looked at both LCL volumes and FCL volumes going down compared to last year and also compared to September. And this decline has been despite some addition from about 1.5% from our acquisitions in Germany earlier this year. So from that point of view, the international supply chain business remains subdued on the volume side. And this is typically the holiday season before Christmas when the volumes pick up, which we have not seen. So on the international supply chain side, given the muted growth outlook in China and continued headwinds in Europe and US as well not looking that good, I would say the international trade for the next 3 to 4 months should remain muted in terms of volumes. On the other hand, on the domestic side, we have been gaining quite well on the volumes. Our express distribution business witnessed almost 18 to 20% growth over the last year. And on the contract logistics business as well, we've been growing well. So international supply chain, of course, remains a concern from a volume perspective for the next few months as well. And we hope that post-Chinese New Year, we should expect some recovery in the global trade.
Everybody is talking about a recession in 2024. So while, all of us are optimistic at heart, but realistically, I mean, if there's a recession in US in 2024, that means international business will remain low.
Yeah, so from our perspective, if you see our business, our key countries have been India, China, parts of Southeast Asia, and a significant majority volumes in Europe, where we are market leaders across key markets. In US, we are still not the market leaders, and we have an opportunity to gain market share. So to that extent, the impact in US can possibly be managed through expansion in market share. But Europe, where we already have high percentage, almost 40% plus market share in LCL consolidation in many countries, the economic downturn really impacts us much more. So naturally, any kind of recessionary headwinds in US would also affect the overall industry negatively. But I would say that unless it's a catastrophic recession, we should be okay in terms of the volumes that we could do in and out of US. And just below US, we also have some pockets of growth in Latin America, which has traditionally been weak for us. But 2024 is a key focus area for us for growing Americas, particularly on the back of Latin American countries as well. So yeah, that's how I would look at 2024.
So net, what would be the volume, figure looking like for FY24 as a whole? Because last few quarters we have seen a decline. For the entire year, what kind of numbers should we expect? And your EBIT per TEU, that actually has taken a complete nosedive from the levels of around 11,000 per TEU, which was the EBIT in last year. It's actually down to 600 rupees. Do you think it's bottomed? And when do you see it heading back to that 10,000 plus levels?
Yeah, so from a volume standpoint, I would say the first 6 months would be more or less mirrored in the next 6 months as well. So volumes would be flattish H1 versus H2 for FY24. In terms of the EBIT margins, they are a function of the leverage on the gross profit, which is, in terms of cost reductions on SG&A costs and also on the industry environment, which allows for utilization. So there, my sense is that gross profits would remain range bound from the current levels for the next 6 months. And we expect that from April onwards, we should see improvements in utilization. And in our business, as the utilization starts going up, the profit margins go up. As you would see, it's a business with high operating costs below the gross profit as well. There's a bit of a leverage there. And that's something which we've already started working on a lot of initiatives on automation, cost reduction, which have already started to kick in. Those benefits would be completed by December 31st, I would say. And while there could be some one-off severance costs, etc., as we automate some of the roles, there could be a part positive and part negative impact in the March quarter. But again, from April onwards, you should see a lower cost base below the gross profit. So a lower cost base and improved gross profit margins should start normalizing the EBIT margins. But as I mentioned, the cost initiatives would also take few months to completely reflect. And on the industry side, we're also expecting pickup only post-Chinese New Year. We don't see any significant rebound in the next 2-3 months. So I would say that expect it to be flattish for the next 3-4 months. And from there on, we should see a gradual rebound in margins normalizing.
Okay, what about express logistics business? Because that has recorded pretty strong volumes in Q2, record volumes driven by the festive demand. Will this momentum continue?
Yeah, so on the domestic express business, if you see, we have been on a transformation journey and that business has done well for us. Last year in FY23, we increased the revenue for express business almost by close to 18-19%. This year, so far, we have seen a volume growth of almost 18-19%. There has been some drop in yield as the customer mix has changed. So typically, when your service levels improve, it's the larger customers who tend to show confidence first, and therefore the margin profile changes a bit, the yield profile changes a bit. But we expect that to improve as we move forward. As far as volumes are concerned, naturally, Diwali month typically tends to be a bit lower, but on an overall basis, we see market has strong potential to grow, and we should continue to maintain and gain market share. So from that perspective, for next 6 months as well as beyond that, we should continue to do good on the volumes in express logistics business for us.
On that note, we let you go. Appreciate you making time and speaking with us. So the volumes for now remain sluggish. That's the expectation for the second half as well. It's only towards the end of the year, financial year that is, that they'll perhaps see a bit of a recovery. But the other stock which has been in focus is KPIT Tech. Over the last couple of days, that stock has actually been declining by almost 11 to 15%. There was a fresh brokerage note that came in. They were talking about whether 20% growth rate will be possible or not for the next 10 years. Margins, they were saying, is likely to dip because Street seems to be valuing a lot as far as growth of the ER&D segment is concerned. Overall, the valuations continue to be very punchy, 60 times FY25 earnings, and then Tata Tech IPO means more competition as well. So that's also putting a bit of a pressure on that stock. In fact, all of these questions is something that my colleague Aishwarya did post to Kishore Patil. He's the CEO and co-founder of the company. Listen into their chat.
So, I think last 4-5 years, last 12 to 13, 14 quarters, we had this consistent growth of 25 to 30%. And we have been in a position to improve margin bit by bit. And we had talked about a few years back about the margins between 18 to 20%. And now for this year, we have guided to grow beyond 37% plus. Also margin of 20%.
There was an analyst recommendation a couple of days back, and it said that you have strong fundamentals, but as compared to global peers, even domestic peers, your valuations are a little higher. So, and they have found a certain risks in terms of some of your clients, which is including Packard, insourcing their some of their techniques and businesses. So a word on that, some clarification on that if you could give us.
So first thing is many analyst reports are there. There are fundamental reports that puts us much ahead than where we are today also. So even there are analyst reports of 1600 or whatever it. So I don't want to go with there because I think they are more expert in their field and they take a call on the company. And fortunately, we have provided good growth over the last 4 years. So this particular part about particular account and Packard is, I think people do comment without having a full information.
In terms of IPOs, this has been a year of bumper IPOs, and in your space, Tata Technologies has been the talk of the town right now. Do you gauge this kind of growing competition, especially in the software tech space? Yours is, of course, a niche service that you provide. Would you think that the competition here is getting tougher, especially in the IPOs, new IPOs that are coming?
So there are two ways of looking at it. First is the company has been there. It is existing company. So already they are doing their business. We are doing our business. So first I said there is enough space for everyone. So the land of the law is there, and we are doing our business, they are doing their business, so that is not there. On the investors side, I think there are many companies and investors have to make their choices. We have a track record and we are comfortable with that, and I'm sure investors will take their own take. So there is a scope for everybody according to the way they have performed in the past as well as in future.
Co-powered by Century Laminates by Manish Malhotra. Fashion for your furniture.
जब भरोसे की हो बैकिंग तो निवेश का हर फैसला बन जाता है बुलंद। इसीलिए हम खड़े हैं हर निवेश के लिए, हर निवेशक के साथ। SBI Securities.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
National Milk Day Rally for 2023 started from Pune, which is a very big city for India. It reached Mumbai then, which is even a bigger city, and it has come to Gujarat now. We have been meeting a lot of people at various touch points where we meet them and tell them the theme of this rally, which is basically a clean fuel rally.
देखिए वो बंदा था ना, विजनरी था। विजनरी मतलब कि उसके दिमाग में अगर कोई चीज़ बैठ जाती है तो लंबा सोच के उसका अमल करने को शायद ये क्लीन मिल्क प्रोडक्शन के साथ क्लीन एनवायरनमेंट के लिए भी जो काम हो रहा है अभी मीथेन गैस का, वो भी ज़्यादा काम है।
मूंगफली। छोटे से छोटा रिस्क भी महंगा पड़ सकता है, इसीलिए SBI जनरल हेल्थ इंश्योरेंस, सुरक्षा और भरोसा दोनों।
इस बार इससे करें।
Fed Bank Financial Services Limited, a retail-focused NBFC promoted by the Federal Bank Limited, a company that's seeking to empower emerging India with easy access to loans, now makes an initial public offer of equity shares of face value of 10 rupees each for cash at a premium. The 100% book-built offer being offered in a price band of 133 to 140 rupees per equity share. Opens 22nd November, closes 24th November 2023. For risk factors and more details, refer to the red herring prospectus.
Indian Renewable Energy Development Agency Limited, a Government of India enterprise, launches an initial public offering of up to 671,941,177 equity shares of face value of 10 rupees each through the book building process with a price band of 30 rupees to 32 rupees per equity share. Bid issue opens on November 21 and closes on November 23, 2023. For risk factors and more details, please refer to the RHP available on the websites of SEBI, BRLM, stock exchanges and the company.
Four walls don't make a home. A home is made with your loved ones and their dreams. All we do is stand by you. After all, it is you who turns a house into a home. SBI Home Loans, always a friend in your journey of making a house a home.
I want to soar above the skies and fulfill my responsibilities. With LIC. Paid your LIC premium? On time. दिल की सुनो, LIC चुनो.
LIC, हर पल आपके साथ.
Trekking in the monsoon is quite a risk. So be careful.
You also take risks, Dad, don't you?
Me? I don't even risk drinking hot tea.
I'm talking about the stock market. Trade only in those products that are within your risk-taking capacity and with knowledge of that risk. Taking too much risk increases the chances of both profits and losses.
Hi, what's that? That's a Manish Malhotra. Not your dress. The cupboard. The laminate is a Manish Malhotra design.
Century Laminates by Manish Malhotra. Fashion for your furniture.
सबका ज्ञान करे परेशान? That's why download HDFC Sky, a new age all-in-one app जो बनाए आपको अपने दम पे एक्सपर्ट, क्योंकि यहाँ सलाह वही जो आपके लिए सही। HDFC Sky, बनो अपने दम पे एक्सपर्ट।
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
पानी से भरी बाल्टी जो जल्दी ऊपर लाएगा वही जीतेगा। हर गेम में चैंपियन जैसी पकड़। वही SRMB TMT।
Welcome back. Still tuned into First Trades. I just want to revisit Honasa, the stock, because it's locked in upper circuit. You did see a pretty strong reaction to the numbers. Don't know if it's actually warranted, but nonetheless, investors clearly cheering that. And after the recent listing, that's nothing short of a pretty splendid move on the stock price. 423.7 locked in upper circuit. All right, let's put the spotlight then on all that's going on within the auto space. And Tesla is set to debut soon in India. What's going to be the impact for some of the other auto majors? Is competition really heating up? And when can we go for a test drive? I don't know if we can, but Hormuz Sorabji, editor Autocar India, certainly will soon. And Arun Malhotra, we've also got an auto industry expert, both joining us on the show. So Hormuz, managed to get your hands on a test drive soon?
Well, I think I drove a Model 3 some years back, and clearly it's an amazing car. We know what Tesla can do in terms of the performance, the software, how all that works. But adapting it to India is still it wasn't quite ready, especially in terms of something like ground clearance. So I think that's one thing they are having to address. Also, for all the hype it has in terms of build quality, really not the best, not as good as, let's say, a legacy car maker who's gone into EVs. So obviously, the Teslas have a certain wow factor. It is the poster boy of the EV world, driven, of course, by Elon Musk. So it definitely has a lot of star value. But I think this is a market that has humbled the biggest of brands. So I would, hold my breath until they come.
Those interiors and everything is looking super slick. And, Mr. Malhotra, I wanted to get in your take, because we're talking about this premiumization trend really picking up in India, people willing to spend that kind of money. Do you think with that, the entry of Tesla into India is really going to cement the fact that people are willing to put their money where their mouth is?
If you look at the Indian market, even today, there are about 10 manufacturers which are making EVs or selling EVs in the country, and 7 to 8 of them are in the semi-premium luxury market. To that extent, the market is still very limited in numbers. I mean, if you look at luxury car market, is 45,000 a year. So even if you take 30% penetration, it makes 12,000. So that extent, the market is very small. And even if Tesla comes in, and there are juries out on that, and as Hormaz mentioned, it's a poster boy of the industry. How much they will be able to sell, and will it really unshackle the industry and bring a price point to the mass market, which is about 8 to 12 lakhs? That's some question which has to be answered.
What is your understanding as to what could be the price range for Tesla?
Wait, asking me,
yes,
Nikunj?
That's right.
Yeah. So I think, the Model 3, they're going to be expensive. Obviously, there's the understanding is that the customs duty will be reduced on that. So by how much, we don't know, but let's assume it's not reduced, because, we can only speculate how much it would be reduced by. I don't think the car could come for anything less than 50, 60 lakhs, maybe even more. So that's quite expensive. I think the larger game plan of Tesla is they are developing a low-cost model, and they're looking at production bases globally. I think that really is the big allure for the government over here to pull in Tesla to develop a strong manufacturing base for a low-cost car. We know that they were looking at Mexico as one opportunity there to develop what is going to be a that car could be in the range of maybe 25 lakhs or so if they can really localize it. So I think that's what is the ultimate game plan, to really bring a low-cost, affordable car fully localized in the market. But before that, they want to seed the brand with some good numbers, and the way they want to do that is with lowering of customs duty. But as current customs duty stand, about 50-60 lakhs is what I think they could bring the car for. That's still quite expensive. Even being a Tesla, volumes for that would be very low. And the other issue is the retail network. I don't know what how they're going to manage that, because that again is a challenge. Tesla have their own retail network and their own distribution, and there are regulations against for FDI in retail. So if they don't have a typical dealer model, and they're going to go direct to consumer, they might have to deal with some FDI issues over there. So really, there's a lot of moving parts to this, and I think a lot is not clear as yet.
Anybody, Hormuz, who's thinking that, look, what happened after Tesla's entry into China, the same could happen in India, that would be a figment of imagination. I mean, the reality in India is very different. It will be very different from China.
It is very different. I mean, look, with that, on that premise, MG launched the Comet in India, because they were quite. They said that, look, this car, and it's one of the best-selling cars, in China, and it's bombed over here. So Indian market very, very different. I think we are very price sensitive, much more than even China is. And at the end of the day, don't forget that you've got some strong brands over here which have locked up the market. Again, it's there are a lot of hurdles, for getting cars into India, setting up a distribution network, all that sort of thing. And at the end of the day, China has a certain amount of scale and a certain amount of volume and demand, where brands like Tesla can really thrive. But over here, we've seen the pyramid really get very pointy at the top end the minute you start going up the price ladder. So I think you just can't compare, and to assume that a car's successful in China is going to be successful here, is a big mistake. In fact, if you look at it, there's a trend that the most successful car manufacturers in the world aren't necessarily successful in India, and vice versa. So those who are very successful in India aren't very successful globally. So what it says is that we have a very unique set of market conditions, consumer dynamics, and it's something that you can't expect that you're successful in one market and you'll automatically be successful here.
It's a very different micro market as compared to the rest of the world. That point is taken, Hormaz. But I don't know, you talked about how the EV penetration in the country still continues to be quite low. So A, what's needed to propel that? Because I think the government is doing a lot already. And do you expect a K-shaped kind of growth coming in when it comes to the EV transition in the next 2 to 3 years?
See, EV penetration in the country is about 1.5%. But if you take the slightly upper end market, luxury market will be around 6 to 7%. Now, the FAME benefit which the government has is only applicable for commercial application. So all the 90% of the EV sales do not come under the FAME benefit. They only get the benefit of the GST. And Arunabha mentioned, the price point is very important. Today, Tesla has a price which, even if you follow, so the challenge is, if you follow the CBU route, it's close to 55-60 lakhs. If you follow the CKD route, which will take time, it will still be 40 lakhs. So you have to create a model uniquely for the Indian market, and then all the challenges of distribution, customer insight, perspective come in. So penetration is still a long haul. Unlike two-wheelers where the penetration is growing, cars are still very low. And the other thing we have to keep in mind, there are different technologies in the passenger vehicle industry which are coming up well. Whether it is hybrid, whether it's flex fuels, whether it's CNG, unlike the two-wheeler. So the penetrations will be a challenge in that sense.
Okay, fair enough. So what, according to you, Mr. Malhotra, do you think that the government should do in order to invite some of the other bigger global brands in the country? Do you think enough has been done, or do you think that a lot more still needs to be done from the government's end?
So if you look at it, already there are about 10 to 12 manufacturers who are selling EVs. The numbers may be small. So the government has got this PLI scheme, which could be made more efficient, and the PLI scheme could be much more proactive. Then you have the advanced cell chemistry scheme, which helps for battery. But for some period of time, the FAME benefit, which is excluded basically for passenger vehicles, it could be made valid for passenger vehicles, and that would also give a thrust to the passenger vehicle sales. Today it is cooled down. That's why there is a limitation on this respect.
Arun Harmas, thank you so much for making time and speaking with us, and fingers crossed that we get to test drive that Tesla in India very soon. Yes, it will be modified and there are a lot of other things that we'll have to watch out for, but fingers crossed nonetheless. But time now to slip into a very short break. When we come back, we'll discuss the real estate sector because that seems to be building on gains. In fact, of course, 15-year high level. But Max Estate is one company which has been quite strong when it comes to the NCR region, and one of their projects has also reached one important threshold. We'll discuss all of that with the management on the other side.